The year was 2011, and the global financial landscape was trembling under the weight of the post-2008 recovery. In the quiet corridors of the commodities markets, a storm was brewing that would eventually see silver prices skyrocket to nearly $50 per ounce, a staggering 170% increase in just 12 months. This wasn't just a rally, it was a vertical ascent that defied conventional economic logic and captured the imagination of every speculative trader on the planet. On April 28, 2011, silver hit an intraday peak of $40.51, flirting with an all-time high that had stood since the legendary Hunt Brothers era of 1980. The air was thick with euphoria as retail investors and hedge funds alike poured billions into the poor man's gold, convinced that a permanent shift in the monetary system was underway. Then, in a blink of an eye, the floor fell out, and the market witnessed a correction so violent it remains etched in the annals of financial history. In the span of just a few trading sessions, silver didn't just dip, it collapsed, losing over 30% of its value in what many analysts described as a targeted decapitation of the bulls. By early May, the metal had plunged toward $33, wiping out more than $6 billion in notional value from the COMEX exchange alone in a single week. This was the moment the world realized that the silver market, for all its industrial utility and historical prestige, was a playground for forces far larger than the average investor. The scale of this wipeout was unprecedented in the modern era, raising immediate and piercing questions about market integrity and institutional manipulation. While the mainstream media focused on technical exhaustion, a darker narrative was emerging, one involving secret margin hikes, massive concentrated short positions, and the heavy hand of the world's largest banking institutions. To understand how $3 trillion can vanish from the precious metals complex in a matter of minutes, we have to look behind the curtain of the exchanges. Welcome to Finance Unfold, where we peel back the layers of the world's most complex financial events to reveal the truth. If you find this deep dive into market mechanics valuable, please hit the subscribe button and turn on notifications to never miss an update. We want to know our global reach, so please drop a comment below and tell us which country you are watching from today. To grasp the magnitude of the 2011 crash, we must first look at the astronomical leverage that was fueling the fire. At the height of the frenzy, traders were using margin accounts to control massive amounts of silver with relatively tiny deposits. A single COMEX silver contract represents 5,000 troy ounces, meaning at $50 per ounce. One contract controlled $250,000 worth of metal. With initial margin requirements hovering around $12,000 at the start of the year, investors were operating with leverage exceeding 20 to 1. This meant a mere 5% move in the price of silver could either double a trader's capital or completely wipe them out. This fragility created a tinderbox environment where any sudden change in trading rules would trigger a catastrophic chain reaction of forced liquidations. Enter the CME Group, the operator of the COMEX exchange, which suddenly initiated a series of aggressive margin hikes that many believe were designed to break the silver rally. Between April 26 and May 4, 2011, the CME raised the cost of trading silver 5 times in just 9 days. These weren't minor adjustments, they were massive increases that raised the capital requirement by over 80% in total. Imagine being a trader with a large position, only to be told overnight that you must post an additional $5,000 or $10,000 per contract just to keep your trade open. For those already fully leveraged, there was no choice but to sell, regardless of the price. This margin massacre created a localized vacuum of buyers, as the very people who wanted to hold silver were being forcibly removed from the market by the exchange itself. Critics of the CME argued that these hikes were timed specifically to protect large bullion banks that held massive short positions against silver. If the price had surpassed $50, these banks, most notably JPMorgan Chase, faced potentially unlimited losses. By raising the cost of entry for the bulls, the exchange effectively provided a get-out-of-jail-free card for the institutional bears who were underwater. The sheer speed of the decline was breathtaking, as silver dropped $6 in a single night of electronic trading. This wasn't a gradual decline driven by a change in supply and demand. It was a liquidity event. When thousands of stop-loss orders are triggered simultaneously in a market with no buyers, the price doesn't just fall, it gaps downward, skipping over price levels entirely. While the 2011 crash is the most modern example of this volatility, the blueprint for silver manipulation was actually written decades earlier. To understand the why behind the 2011 event, we must look back at the 1980 Silver Thursday, when the Hunt brothers tried to corner the market. Their failure didn't just bankrupt a family, it proved that the rules of the game can be changed midstream to prevent anyone from beating the house. Nelson Bunker Hunt and William Herbert Hunt were Texas oil billionaires who believed that paper currency was a ticking time bomb. Starting in the early 1970s, they began accumulating physical silver on a scale never seen before or since. By 1979, the Hunts and their partners controlled an estimated 200 million ounces of silver, which was roughly 1/3 of the entire world's privately held supply. As the price rose from $6 to over $49 in 1980, the Hunts weren't just trading paper, they were demanding physical delivery of the metal. This created a massive supply squeeze that threatened to collapse the global jewelry and industrial sectors. At one point, the silver in a bag of old coins was worth more than the face value of the currency, leading to a frenzy of people melting down family heirlooms. Just like in 2011, the regulators and exchanges stepped in when the wrong people started winning too big. The COMEX suddenly adopted Silver Rule 7, which restricted any new long positions and only allowed for liquidation. Effectively, they told the world you could sell silver, but you weren't allowed to buy it, which fundamentally broke the discovery mechanism of the market. The Hunts, who were heavily leveraged with billions in debt, saw the value of their collateral evaporate instantly. On March 27, 1980, they missed a $100 million margin call, and the silver market plummeted 50% in a single day. The Silver Thursday crash was so severe, it nearly took down several major Wall Street brokerage firms, requiring a $1.1 billion bailout from a consortium of banks. The 1980 event established a precedent. Whenever silver moves too fast or threatens the stability of the banking system, the referees will change the rules. Fast forward back to 2011, and the similarities are impossible to ignore. The 37% crash in 2011 occurred right as silver was challenging the $50 resistance level that had stood for 30 years. Many analysts point to the concentrated short as the smoking gun of the 2011 manipulation. Data from the Commodity Futures Trading Commission, CFTC, showed that a small handful of banks held short positions equivalent to nearly 25% of the annual global mine production. In any other market, such a concentration would be flagged as a monopoly, but in silver, it was treated as standard hedging. If silver had broken through $50 and headed toward $100, these banks would have been forced to buy back their shorts at any price, creating a short squeeze of biblical proportions. The margin hikes of 2011 effectively prevented this squeeze from happening, saving the banks billions at the expense of retail investors. The question remains, was this a move to protect the market or a move to protect the manipulators? The psychological impact on investors was devastating, as many had moved their life savings into silver as a hedge against the debasement of the dollar. When the price crashed, the narrative in the media shifted instantly from silver is the new gold to silver is a dangerous bubble. This rapid shift in sentiment is a classic hallmark of an orchestrated market shakeout. Interestingly, the 2011 crash coincided almost exactly with the news of the raid on Osama bin Laden's compound. While the world was distracted by geopolitical headlines, the silver market was being dismantled in the dark. This timing has led many to believe that the liquidity event was masked by the noise of the global news cycle to avoid public scrutiny. As we analyze the data from that period, the paper-to-physical ratio becomes a critical metric. For every ounce of physical silver in a COMEX vault, there were hundreds of ounces being traded in the paper futures market. This means the price was being determined by the trading of promises, rather than the actual exchange of metal, a system that is inherently prone to manipulation. The 2011 crash wasn't just a correction, it was a warning shot. It showed that the invisible hand of the market is often wearing a very visible institutional glove. As silver plummeted 37%, it left behind a trail of bankruptcies and a profound distrust in the commodity exchanges that persists to this day. The aftermath of the crash saw a flurry of lawsuits and investigations. In 2015, JPMorgan Chase found itself at the center of a massive class action lawsuit alleging that it had intentionally suppressed silver prices for years. While the bank initially won dismissals, the pressure from regulators and the public only continued to mount as more spoofing evidence came to light. To truly understand the biggest manipulation in history, we have to look at how these massive banks operate in the dark pools of the silver market. They don't just trade, they dominate, using high-frequency algorithms to place and cancel thousands of orders in milliseconds. This spoofing creates a false sense of supply or demand, tricking other traders into moving the price where the bank wants it. The 37% crash in 2011 was the culmination of these tactics, a masterclass in how to destroy a bull market using regulatory tools and overwhelming paper force. But as we will see, the story doesn't end with the crash. The events of 2011 set the stage for a decade-long battle between silver, stackers, and the institutional giants that still rages in the markets today. The infrastructure of the silver market is built on a foundation of paper, and to understand the 2011 crash, one must understand the staggering disparity between the physical metal and the digital contracts that dictate its price. In the world of precious metals, paper silver refers to futures contracts, options, and exchange-traded funds that track the price of silver without requiring the holder to ever touch a physical bar. By the time silver approached $50 in 2011, the volume of these paper promises had reached a fever pitch, with some estimates suggesting that for every ounce of silver in a vault, there were over 100 ounces being traded on the screen. This extreme leverage created a scenario where a relatively small group of institutional players could move the price of an entire global commodity through sheer digital force. While retail investors were buying physical coins and bars, the Big Four and Big Eight commercial banks were piling into concentrated short positions on the COMEX. These banks weren't just hedging, they were essentially betting against the very existence of a silver shortage. If you haven't already, please subscribe to Finance Unfold to stay informed on how these institutional maneuvers impact your wealth. At the center of this paper fortress stood JPMorgan Chase, a bank that had inherited a massive short position in silver following its acquisition of Bear Stearns during the 2008 financial crisis. For years, analysts had noted that JPMorgan's position was so large, it fundamentally distorted the market's natural discovery process. When silver began its parabolic run toward $50 in early 2011, this short position became a multi-billion-dollar liability, threatening the bank's balance sheet and forcing a confrontation between the paper shorts and the physical longs. The mechanism used to break the rally was as surgical as it was brutal. Starting on April 26, 2011, the CME Group, which oversees the silver futures market, began a rapid-fire series of margin increases. In the span of just 9 days, the capital required to hold a single silver contract was hiked 5 times, eventually increasing the cost by a staggering 84%. This was the financial equivalent of a landlord demanding 3 years of rent up front in the middle of a lease. For many traders, these margin calls were impossible to meet. They were forced to liquidate their positions at any available price, creating a self-reinforcing downward spiral. This was not an organic shift in market sentiment. It was a forced deleveraging event triggered by a change in the rules of the exchange. As thousands of long contracts were dumped onto the market simultaneously, the price of silver plummeted, allowing the big banks to close out their dangerous short positions at a massive profit. The timing of these hikes was particularly suspicious, as they occurred just as silver was testing the critical $50 psychological barrier. Historically, when a commodity breaks through a multi-decade resistance level, it often triggers an even more explosive rally as momentum traders and algorithms pile in. By hiking margins at that exact moment, the exchange effectively cut the oxygen to the fire, ensuring that $50 would remain an unbroken ceiling for years to come. As the price crashed 37% in those fateful weeks, a new term began to circulate among disillusioned investors: spoofing. This is a technique where high-frequency trading algorithms place massive orders to buy or sell a commodity with no intention of ever executing them. The goal is to create a false impression of market depth, tricking other traders into moving the price in a specific direction. While it was once considered a conspiracy theory, legal developments years later would prove it was a standard operating procedure for some of the world's largest banks. In 2020, the U.S. Department of Justice announced a landmark $920 million settlement with JPMorgan Chase to resolve charges of market manipulation in the precious metals and treasury markets. The investigation revealed that for nearly a decade, including the period surrounding the 2011 crash, JPMorgan traders had engaged in tens of thousands of instances of spoofing. The DOJ described the bank's precious metals desk as a criminal enterprise, a startling admission for one of the world's most powerful financial institutions. The evidence presented in these cases showed that traders would layer the order book with massive sell orders just above the current price to prevent silver from rising. When retail buyers tried to push the price up, they would see a wall of selling pressure that didn't actually exist. Once the retail buyers gave up and started selling, the bank would cancel its fake sell orders and buy the silver at a lower price. This stop-loss hunting was a key factor in the extreme volatility of 2011. Beyond spoofing, the London silver fix was another pillar of the paper fortress that came under fire. For over a century, the global price of silver was set daily by a small group of banks in a private conference call. This opaque system was ripe for collusion, and subsequent lawsuits revealed that traders from Deutsche Bank, UBS, and HSBC were frequently communicating in chat rooms to coordinate the fix. These chats, filled with bravado, showed traders jokingly calling themselves the Mafia as they moved the price to suit their daily options positions. The 2011 crash also highlighted the massive disconnect between the spot price seen on television and the actual physical price paid for real metal. As the paper price on the COMEX was being hammered down by margin hikes and spoofing, premiums for physical silver coins like the American Eagle began to skyrocket. This meant that while the market said silver was worth $35, you couldn't actually buy any for less than $40. This divergence is the ultimate proof that the paper market is often a fictional representation of reality. This divergence is critical for understanding why the biggest manipulation in history was so successful. By controlling the paper price, the banks were able to discourage investment and keep the cost of industrial silver low, even as the real-world supply was tightening. Silver is a unique asset because it is both a store of value and an essential industrial component used in everything from solar panels to electronics. If the price reflects its true scarcity, the cost of technology would rise significantly. The role of the Commodity Futures Trading Commission, CFTC, during this period remains a subject of intense debate. Despite receiving thousands of complaints from retail investors about the obvious manipulation in 2011, the CFTC closed its 5-year investigation in 2013, stating it found no evidence of wrongdoing. It took another 7 years and the involvement of the Department of Justice for the truth about spoofing and racketeering to finally come to light, leading many to question the effectiveness of the regulators. One of the most revealing pieces of data from the 2011 crash was the movement of silver out of the SLV ETF, the largest silver exchange-traded fund in the world. As the price crashed, massive amounts of silver were reportedly being moved from the ETF's holdings into private vaults. Some analysts believe this was the moment when institutional players like JPMorgan flipped their strategy from being net short to net long, using the crash they created to accumulate physical metal at a 37% discount. If this theory is correct, the 2011 crash wasn't just about saving the banks from their short positions. It was an elaborate shakeout designed to transfer wealth from the public back to the institutions. By crushing the price and destroying investor confidence, the banks were able to buy up the world's remaining silver supply, while the mainstream media told everyone that silver was a burst bubble. This is the classic playbook of institutional accumulation. To visualize the sheer scale of this, consider that in the months following the crash, JPMorgan's own silver warehouse on the COMEX suddenly began to grow at an exponential rate. From holding almost 0 ounces in early 2011, the vault grew to hold over 100 million ounces within a few years. While the bank claimed this was merely client silver, the coincidence of the largest bank in the world building a massive silver stockpile right after a historic price collapse did not go unnoticed by market veterans. The paper fortress is designed to ensure that the price of silver is determined by the trading of debt and promises rather than the exchange of physical goods. This system allows for the creation of infinite supply on paper, which can be dumped onto the market at any time to suppress a price rally. As long as the majority of investors are content to trade digital contracts rather than demanding physical delivery, the paper fortress remains impenetrable. However, the events of 2011 also sowed the seeds of the modern silver squeeze movement. A generation of investors learned that you cannot trust the electronic price and that if you don't hold it, you don't own it. This shift in mentality has led to a persistent drain on exchange inventories as people move their wealth into physical bullion, slowly chipping away at the foundation of the paper market. As the dust settled on the 2011 crash, the financial world began to reckon with a new reality. The silver market had become the ultimate battleground between centralized banking power and decentralized retail sentiment. The 37% decline was not just a statistical anomaly, it was a psychological operation that successfully sidelined a generation of precious metals investors. Yet, for those who remained, the focus shifted from when silver would hit $100 to how the system was being maintained. Subscribe to Finance Unfold to join our community of investors who look beyond the headlines to find the real mechanics of wealth. The decade following the 2011 collapse saw silver enter a long, grueling bear market that many believe was artificially prolonged through the same paper tactics used during the crash. Between 2012 and 2019, silver prices remained suppressed, often trading in a tight range that frustrated bulls and led to a massive exodus of capital from the mining sector. During this time, the big banks were not idle. They were fundamentally restructuring how they interacted with the COMEX. The criminal investigations that began in the wake of the 2011 volatility eventually led to a total of 6 employees from JPMorgan being charged with racketeering and market manipulation. The evidence revealed that these traders didn't just manipulate silver occasionally. They treated it as a daily profit-generating machine at the expense of everyone else. By using high-frequency algorithms to spoof the market, they could move prices by cents or dollars at will, collecting billions in trading profits, while the actual producers of silver struggled to stay solvent. One of the most significant revelations from the DOJ's investigation was the existence of the cartel, a group of traders who used private messaging apps to coordinate their moves. These transcripts showed a brazen disregard for market laws, with traders literally telling each other when to hammer the price of silver to trigger stop losses. This coordination ensured that no single bank would be caught on the wrong side of a move, effectively turning the silver market into a closed-loop system controlled by a few desks in New York and London. This oppression has massive real-world implications, particularly for the green energy transition. Silver is the most conductive metal on Earth, making it indispensable for solar panels, electric vehicles, and 5G infrastructure. By keeping the price artificially low through paper manipulation, the financial system has essentially been subsidizing the cost of industrial components at the expense of silver miners and individual savers. The biggest manipulation in history reached a new chapter in early 2021 when a movement known as the silver squeeze attempted to replicate the GameStop phenomenon in the silver market. Inspired by the historical evidence of 2011, thousands of retail investors began buying physical silver and silver ETFs simultaneously, attempting to force the banks to cover their massive short positions. For a brief moment, silver spiked above $30, and bullion dealers worldwide ran out of stock. However, the paper fortress proved resilient once again. Just as in 2011, the moment the price of silver began to threaten institutional short positions, the margin requirements were hiked. On February 1st, 2021, the CME Group raised margins on silver by nearly 18%, effectively stalling the momentum of the retail crowd. It was a haunting echo of the 2011 margin massacre, proving that the rules of the exchange remain the ultimate weapon against a long squeeze. Despite these interventions, the underlying fundamentals of silver are reaching a breaking point. Global demand for silver has exceeded mine production for several consecutive years, leading to a persistent structural deficit. This means the world is currently using more silver than it digs out of the ground, relying on dwindling stockpiles to bridge the gap. In any other market, a multi-year supply deficit would lead to a massive price surge, yet silver remains significantly below its 2011 highs. The disconnect between the physical reality and the paper price is now wider than ever. We are seeing a historic drain of silver from the London Bullion Market Association, LBMA, and COMEX vaults as large buyers, potentially sovereign nations or private billionaires, demand physical delivery. When the silver in these vaults hits a critically low level, the paper market will no longer be able to settle contracts in metal, potentially leading to a force majeure event, where the exchange simply settles in cash. A cash settlement would be the ultimate admission that the paper market is a sham. If you hold a contract for 5,000 ounces of silver, and the exchange tells you they don't have the metal and will instead give you paper currency, the price of physical silver would instantly decouple from the screen price. We would see a two-tier market where the physical metal trades at a massive premium to the electronic, quote, rendering the COMEX obsolete. The 2011 crash was a preview of what happens when the paper market is used as a blunt force instrument. It wiped out the weak hands and consolidated the metal into the strong hands of the banking elite. But as the world moves toward a more multipolar financial system, the ability of a few Western banks to dictate the price of a global commodity is being challenged by Eastern exchanges, such as the Shanghai Gold Exchange, which deals primarily in physical metal rather than paper futures. Investors today must view silver not just as a speculative trade, but as a strategic asset. The 37% crash in one day was a masterclass in market capture, but it also highlighted the inherent value of an asset that banks feel the need to manipulate so aggressively. If silver were truly just another metal, the levels of spoofing, margin hikes, and regulatory theater we have witnessed over the last 2 decades would not be necessary. The history of silver is a history of money, power, and the lengths to which institutions will go to maintain the status quo. From the Hunt brothers in 1980 to the 2011 margin massacre and the modern-day spoofing scandals, the pattern is clear. The market is designed to reward those who understand the rules and punish those who follow the official narrative. Understanding this manipulation is the first step toward protecting your purchasing power in an era of unprecedented debt. As we look toward the future, the lessons of 2011 remain more relevant than ever. The massive concentrated short positions still exist, the paper-to-physical ratio is still astronomical, and the regulatory environment is still skewed in favor of the large institutions. However, the transparency afforded by the internet and the rise of independent financial analysis means that the man behind the curtain can no longer hide his moves as easily as he once did. The story of the silver crash of 2011 is a cautionary tale about the dangers of leverage and the reality of market intervention. It serves as a reminder that in the world of high finance, the price is often a reflection of what the most powerful players want you to see, rather than the true value of the underlying asset. By staying informed and diversifying into physical assets, you can opt out of the digital manipulation that has defined the last century of trading. We have covered the astronomical rise, the coordinated margin hikes, the criminal spoofing, and the structural deficits that define the silver market. This is the reality of the biggest manipulation in history. It is a saga of institutional survival at the expense of the individual, but it is also a story of a metal that, despite everything, refuses to be forgotten. The next decade will likely determine whether the paper fortress holds or finally crumbles under the weight of physical reality. Thank you for joining us on this deep dive into the hidden world of silver manipulation. If you found this professional analysis insightful, Please subscribe to our channel, Finance Unfold, and hit the bell icon to stay ahead of the markets. Our mission is to provide you with fact-based, story-driven content that empowers your financial decisions. Don't forget to like this video and share it with others who want to understand the truth behind the market's biggest moves. By understanding the mechanics of the 2011 crash, you are better equipped to navigate the volatility of the years to come. The financial landscape is shifting, and those who are prepared will be the ones who thrive. We appreciate your support and look forward to seeing you in our next deep dive into the forces that shape our world. This is Finance Unfold, signing off.